Hi, I'm Suzette Kitzelman and welcome to Suzette Sells LA. Today I'm going to show you how to save money on mortgage interest, okay? Because you know when you first get a mortgage and you sign those papers, you see exactly how much interest you're going to be paying over the life, the 30-year loan, and it's often pretty disconcerting. But there are ways to save money and not pay all that interest, okay? So I'm going to show you. This is the process. It's going to be about 7 minutes. I'm going to try to keep this to 7 minutes, okay? So if this is your mortgage and this is year one, every year that you pay, this is year 5, 10, you get all the way to the 30-year mark, what happens is your mortgage interest is front loaded. In America, the banks load your mortgage interest to the front so that the first year you're making mostly interest payments and you're paying very little principal down of your actual loan amount, okay? It's a funny thing. I don't know why they do this, but in Canada and the European Union, it's every payment that you make is the same amount of loan payment, principal reduction, and interest. It's a horizontal line. But in America, they front load your mortgage interest so that you're paying most of it. The bank gets most of their profit pretty early in the life of the loan. Okay, so now I'm unveiling. Oh boy, there goes I'm unveiling. Okay, good. Are we still rolling? Okay, great. So here's what you do. As soon as you get your mortgage loan funded and you've bought your new home, call and ask your lender for a mortgage payment schedule. This is not an amortization schedule. It's a different thing, and they won't give it to you unless you ask for it. Basically what it is this. It shows you each payment broken down so that you know exactly how much principal you're paying and how much interest you're paying each time. And because this is a diagonal line here and the amount of interest you pay is the highest on your first payment, it's going to change with every payment, okay? This will print out for 360 payments. This is the first year, the first 5 months I've put, just for an example, okay? So what happens? Let's imagine that your mortgage payment is $2,000 a month. Now these figures are not actual based on your loan because we don't know your interest rate or anything like that. But if, for example, your loan payment is $2,000 a month and it's a fixed interest rate loan, maybe you're going to pay $5 of principal and $1,995 of interest on your first mortgage payment, okay? The mortgage payment doesn't change. It's always $2,000 all the way to the end of the 30 years, which is why it's a great reason to buy instead of rent, because rents keep going up. And once you get your mortgage, it's going to stay the same. Anyway, so back to the story here. $2,000 a month, your first principal payment is only $5. Your second one might be only $10. It might go up to $15 on the third payment, to $20 on the fourth payment, $25 on the fifth payment. For example, these are just numbers to give you an idea of how the mortgage payment schedule breaks it down. So if you want to save some mortgage interest, every time that you make this payment, you're going to write this check. You're going to put your mortgage loan number on the check for $2,000, and you're going to include in that same envelope another check. It's going to be a second check. It's not going to be another $2,000 check. It's going to be a check for this amount, the $10, okay? This amount is the principal for the next mortgage payment, okay? You're going to include that. And what happens, what that does is, next month, you're still going to owe your $2,000, and the month after that, and the month after that. But what this does is, this keeps you from having to pay this much interest on the back end of your mortgage, the back end of your loan. So if you, oops, I'm sorry, I'm wiping out numbers here. Anyway, so every time that you make a mortgage payment, if you include a second check for this much money, the amount of the principal payment for the next month, you're going to pay down your loan a whole lot faster. Now, of course, this number is going to keep going up, and sometimes you won't be able to do that whole thing. You won't be able to do a whole check in that size, because by the time you get to here, your principal will be half of this, and you may not be able to do that. That's okay. It's not a big deal. Every month that you can, if you do this, Right, so before we were so unceremoniously interrupted by a telephone call, sorry about that, what happens is you're going to add in the next check, a second check in each mortgage payment envelope for the next month's principal payment, okay? But there's something very important that you need to know, okay? A check is actually a contract between you and the bank and the person who's cashing the check, okay? So what you're going to do is come down here. Let's have a look here. Your additional check is going to be made out to your mortgage bank. This first one for $10, okay? And you write out the amount, of course. You're going to put your loan number here. And you must write on this memo line, on your check, write principal reduction on the memo line, okay? I'm going to do that right now. Okay, ... Okay, and of course you're going to sign your check. Now, when this goes to the bank, they're going to deposit it. And what happens is 2 weeks after you do that, after you've made this payment, they're going to deposit it and you're going to show that you've made this payment. You're going to call them and make sure that they've applied this to principal. And the fact that they've deposited a check that says principal reduction forces them to give you credit as principal reduction. That means paying your loan amount instead of interest. Because if you don't write this here, they will just pocket that money and call it prepaid interest. And you don't want that. That's their profit. You want to pay off your house as fast as you can. So this is the way the loan works. You don't want to pay too much interest in the beginning. You pay a second payment that comes from the principal amount of the next payment. Does that make sense? I hope it makes sense. When you're looking at your mortgage payment schedule, which you have to request from the bank, it's a lot of pages because it's 360 payments, all listed one by one, showing each breakdown of how much interest you're paying and how much principal you're paying. See? So every time you make a payment, you pay down the next month's principal in a second check. And remember, your extra check has to say principal pay down, okay? Principal reduction. And then 2 weeks later, call the bank and make sure they applied it to the principal, okay? You'll be surprised how fast this makes your loan pay off. Anyway, I'm Suzette Kitzelman with Rodeo Realty in Beverly Hills. Thank you for watching, and please subscribe if you like my video. Thank you. Bye.